Hello, viewers. Welcome to today's learnings. So we would learn today about how do we prepare the financial statement of a business, which is a non-company business, meaning this particular business is not a company form of organization. So this is not a corporate entity. So what do we mean by a corporate entity? Generally, we understand corporate as a company. So smaller organizations like proprietorship business or partnership business, we call them as non-company. So non-company businesses are, if you look at, basically, we understand proprietorship business or partnership business. So these are smaller versions of business organization. Yeah, they also into business activity. They undertake economic activities, that is buying and selling of goods, or they manufacture goods or services and they sell them to the society with a profit motive. And their owners, the proprietors or the partners, the partnership firm, they earn their profit out of this place. So these are also economic entities. They're also profit-oriented entities. But the problem here is, or I would say, the benefits rather, not a problem for them, but rather the benefit here for these sort of smaller organizations, which are not company form of organization, is there is no such, law or rules or regulations which require this form of business organizations, smaller form of business organizations, to prepare the financial statement as per particular format or as per certain, prescribed format or guidelines or some prescribed manner or so. There is no such prescribed guidelines. I'm making it clear. So therefore, for preparing the financial statement for these smaller organizations, be it a proprietorship organization or partnership business organization, we generally go by the standard normal accounting practices. The way the accounting tell us, the accounting as a discipline tell us how do we arrive at the profitability of the business, or how do we report the financial position of the business. So we go by that general understanding which is there in accounting, but there is no law, there is no regulation per se which governs or which requires to prepare the financial statement of these smaller businesses as per certain prescribed format, prescribed manner. So when we look at basically when these businesses prepare their financial statement, what does their financial statement include? That is the first question. So now understand that when we look at the financial statement of a smaller business, they are generally pretty much interested about knowing their financial performance. That is what we call it as profitability. So this financial performance. Yeah, financial performance, and that we otherwise call as profitability. So whether the business is running profitably or we are suffering losses, or what is the position when it comes to our operational efficiency, how efficiently we are running our business. That is basically our financial performance. So financial performance, we generally call it as our profitability. How profitable our business operations are. That is the first thing any owner, any proprietor, or any partner of a partnership firm would be interested to know about. And then the second, the statement which generally these smaller businesses they second thing, or second, I believe, the factor or the second important information which the business owners and also other stakeholders, those who are interested about the business, they want to know is that What is the financial position? Financial position of the business. This one, financial position here, I mentioned, and also the first part I told you, financial performance. Financial performance is the profitability, and now financial position. So when we see the financial position, generally we understand the financial position by the resources of the business, how much resource is under control of the business, how much resource the business is controlling. Resources under control of the business. And these resources also we call it as an accounting terminology, assets. So how much assets the business owns or how much asset the business control, that is what, important thing when it comes to understanding the financial position. And also these resources are created by the business with fundings. There are lenders and there are owners and proprietors, partners. They fund to create resources for the business. So how these resources are funded? Funding part of it. The source of money to create these resources. Fund. How we or which are the resource which are the sources of the funds with which we have created these resources. So the funding part of creating resources. So two aspects are basically disclosed here. One is the resources which the business owns or controls, number one. Number two, how these resources are funded with. What with these resources are funded. Who all funded these resources or given money to business to create these assets. That is the second part of understanding our financial position. So in the financial position, when we look at, generally we understand two things. One is, here I once again mentioned, change the color, let's say. Yeah. When we look at financial position, two things. One is the resources and the funds. Which are all resources business is now owning or controlling, and how these resources are created by the funds, who are the fund givers to the business. So all these are the thing we have to know from the financial position. So these are the two important statements, I believe, or two important information which in the financial statement we generally produce to our owners, to the partners, proprietors, even the bankers, lenders, those who are interested to know about business and its performance. So one statement, as we understood, is the financial performance statement, financial performance, and the other one is our financial position statement. And in accounting, these two statements are technically called as, one is statement of profit and loss or profit and loss account certain case. Profit and loss account, generally in smaller businesses, it is called as profit and loss account. Like this. Profit and loss account. Because it is in the format of an account, ledger account is prepared. So in smaller businesses, we prepare as an account. So we call it as statement of profit loss or profit and loss account. But in larger businesses like company, we call it as statement of profit loss because we do not prepare it in a ledger format. Rather, we prepare in a statement R or less format. So we call it as statement of profit loss. But in this smaller business, this statement of profit loss is prepared in account, ledger account format. So we call it as profit and loss account. And that is basically our financial performance report card. Okay. That is our financial performance report card. It shows net profit, net loss. That is the first part of the financial statement. And the second part to the financial statement is the position which we saw, resources and the funds. The statement which shows that the funds and resources which are controlled and used by the business, that is the statement is called as the balance sheet. It is another, also typical accounting name given. So this is the balance sheet, which shows basically the assets or resources, and the liabilities are the funds. Which all funds we got? Where from we got the funds to create these assets? So these assets and the funds. And there is a very, very important relationship between the firm, these two, items or two set of things which are there disclosed in the financial in the balance sheet is assets are always equal with the liabilities. That is the very, very fundamental relationship between these assets and liabilities. And when we say liabilities, liabilities are divided into two parts: internal and external. And internal liabilities, we call them as capital, and external liabilities, we call them as liabilities. Basically, lenders' money are liabilities, outsiders' liabilities. That is basically we call it as liability. Internal liability is basically called as capital. So when we generally quote liability, we mean external liability, because for internal liability there is a name used as capital. So if we put this particular asset and liability relationship in a mathematical format, this boils down to assets equal to liability. As we understood, it is external, and then also there is another internal liability, but there is a separate name for it, which is capital. So this is the equation, or this is the mathematical relation: asset equal to liability plus capital. This is the fundamental relationship on which the balance sheet is prepared. We disclose the assets and how these assets are created with the funds, which are the funds which we have raised to create these assets. And the beautiful relationship is asset will be equal with the liability and capital. And here, if you ask me the mathematical relation here in the profit loss account or net profit, it is also based on a mathematical principle, which is net. Net we are getting net of what? Net of something. So here we are getting net of something. What is net of something? Basically, net profit is nothing but net revenue. Net revenue or net income. And when we say net revenue, net income, so this also quite easy to understand. This net income must have a revenue minus something, because we are ordering what? Net. So net is something which is after refinement, after deduction of something from the revenue. So here, if you look at net revenue, basically from revenue we adjust or we minus the cost which we incur to generate that revenue. Let's say we are selling goods. So basically the cost price of the goods which we sold out, that would be the expenses for our revenue. So we minus cost prices and other related expenses to make the sale. From the sale revenue, we get the net revenue. And this net revenue technically called as net profit or loss. So the formula, if we understand, it is now simple for us. So this is basically revenue minus expenses to on this revenues. This is the formula for the net revenue, which we call it as net profit. So how much worth of goods or services we sold out, and what are the costs we incur to make that sales and all, we minus out, we get the net revenue, which is there in our hand. That is the surplus by doing business. That is basically the reward for taking the risk of doing business for a proprietor, for a owner of a business. And that is basically called as the net profit. And the business should be appreciated, or the business should be called as doing well if it is really earning higher profit. If it is earning higher profit, so we call it as it is really making higher net profit. Okay, so we understood as a part of the financial statement, what do we prepare? One is the performance statement or a profitability statement. Technically in accounting, we call it as profit and loss account or statement of profit and loss for company form of business, and for non-company business we call it as profit and loss account. And another statement as a part of the financial statement is the balance sheet. Basically, that is the position statement, financial position statement, and it shows or it discloses the assets and liabilities, funds and the resources, assets and liabilities. And also I explained clearly that relationship between assets and liabilities, that is the equation where we present asset equal to liability plus capital, and that is nothing but that is also a very familiar accounting jargon which we use to show this relationship, that is accounting equation. Accounting equation. So this relationship between asset, liability, and capital. So we got a sense of what is all about financial statement of a non-company business, smaller business, like proprietorship or partnership form of business. And now we would see the format of preparing this financial statement. And the first is our income statement. As I was telling you, income statement is that statement which gives us the profit or loss of the organization or profit or loss of the business. So when we do a business for a period or for a period of 6 months or 1 year, so we see how much profit or how much loss we have made. So for that purpose, we prepare a statement which we call it as profit or loss statement. And certain cases also we prepare in an account format, ledger account format, P format. So that case we call it as profit and loss account, P and L account. But here we have presented in a statement format, add or less format. So we are calling it as income statement, or you can say statement of profit and loss. So now let us see how the format look like. Here, as I told you, we are going to arrive at the net revenue. That is our objective. So when we are looking at calculating net revenue, we will take a difference between the revenue and the expenses. So let us see how the format look like, and let us understand also the format, how to arrive at the ultimate net revenue, that is the net profit of the business. And before we arrive at the net profit, there is also another level of profit which is calculated, and we call it as gross profit. Gross profit. Gross profit is little crude profit. Crude in the sense it is absolutely not refined. It is not absolutely the net. After adjustment of all expenses, we are not getting this. Still, there are certain expenses, like you see here, these expenses that we minus from this gross profit. So this gross profit is a crude profit, crude form of the profit. The absolute refined from the profit is basically called as the net profit. Now let us see the format, understand it. See, first we will take the revenue of the business, which we call it as net sale. Net sale. See, net sale here. Net sale is nothing but sales minus sales return. And with that, we will make necessary adjustment with regard to arriving at the net revenue, that is, these are the profits. So first, at the first level, as I told you, there are two levels in the profit calculation. One is gross profit level, and another is net profit level. So at the first level, or at the gross profit level, we would minus basically the cost of the goods which are sold. Cost of the goods sold. Basically, what we are doing, this is basically a calculation, hard-based calculation, where the net result of this, there's entire closing stock, opening stock, net purchase, carriage, wages, and all these are, we will get what is the cost of the goods sold, which fetches this sale value, net sale value, which we are seeing. Always sale value is the net sale value adjusted for return. Those goods, those sold things returned to us, they are not our revenue or sale, so we generally minus. So when we say sale or revenue, we mean net sale. And what is the cost of the goods which we have sold to get this revenue? The calculation is basically this. So I will little elaborate how this particular calculation. Basically, we buy goods to sell. So we have our purchase. Purchase is basically the expense for our sell. But what happens certain time is the entire purchase may not be sold. Okay, certain cases we never sell the entire purchase which we have made. For example, we purchase 100 worth of goods. But when we are during the period, let's say it is a month. So at the end of the month, when we are looking our store, we are still finding some stock lying there. That is the, let's say, closing stock. Closing stock, let's say, is 10. So now we purchase during the month 10 rupees or 100 rupees of stock, and at the end of the month we are having 10. So 90 we have actually sold. So therefore, when we will be minusing from the sell value of the goods, we would not be minusing the 100 because the 100 is not sold out. Still, there is 10 out of the 100, and we sold out really 90. That is the cost of the goods which are purchased and these are sold out. So 90 is the cost of the goods which are sold. So when we calculate, profit, we would minus 90, and this is calculated. 90 is calculated, which is, we can say, cost of goods sold, and in this case we calculated purchase minus closing stock. But in the running business, you find the business would be having some stock at the beginning of the period, which we call it as opening stock. Let's say opening stock at the beginning of the period was 5. Another scenario I'm changing, including opening stock. Opening stock was 5. So now opening stock was 5 and we purchased 100 worth of goods during the period, let's say a month or so. So the total goods or total cost of the goods available for sale was, now, if you make another calculation here, let's say it was 105. 5 was opening, now we purchased in the period 100. Total goods available for sale is now 105. Let's also assume that at the end of the month or the period when we are checking your storeroom, you are finding again the same amount, let's say 10 rupees of closing stock. Okay, so now this was available for sale, and still at the end of the period we are getting 10 rupees with us, 10 rupees of stock with us. Then how much we have sold out? 95. So this becomes the cost of the goods which are sold out, which fetched us, which gave us our sell revenue or net sell revenue. So this is basically our adjustment we have made in the format of this, format of the statement of profit loss or income statement. So the cost of the goods sold generally we calculate as opening stock plus the purchase minus the closing stock. This is what will give us the cost of the goods sold. But to complete our purchase, we have to incur certain expenses. Yes, we pay to the supplier the buying cost of the good. We pay to the supplier buying cost of the good. See, here the purchase we generally mean basically the amount paid to the supplier of the good. So that is the buying cost of the good. But to bring the goods to our business or to our warehouse or go down, we also require certain additional expenses in form of loading and unloading to vehicles, and the transportation charges, to take the goods from the suppliers premises to our premises, to our business. So these are called as carriage. Transportation charges is called as carriage on purchase. Loading, unloading, the leverage should be doing, so we pay them wages. So these are some incidental or expenses pertaining to make the purchase complete. These are called as direct expenses relating to purchase. Like, here I mentioned two direct expenses. Like, these are basic and general expenses incurred with regard to purchase. These are called as direct expenses. because these expenses are necessary to make the purchase complete, to bring the goods to our business. So certain cases they are to be included in the purchase uh, value, in the sense the purchase value would be the buying cost of the good and the direct expenses, buying cost of the good and the direct expenses. So then if you redefine the purchase, so purchase would be buying cost of the good plus direct expenses. So that is how we can understand. But if you take purchase is only the value paid to the supplier, we have to add the direct expenses separately. Here, if you look at the format which I stated, I mentioned net purchase there. Like net purchase is basically always the purchase minus return. That is the standard, I believe, understanding. Because when we purchase, if goods are not up to the mark or our expectations, or they're damaged, or they're defective, so we return to the supplier. So our purchase is basically the net purchase, and here I take a net purchase and I have added the other direct costs with regard to the purchase. So here my purchase is not including the direct expenses. I taken in the purchase only the buying cost of the good and separately added the direct expenses. So all in all, now we redefine the cost of the goods sold, and that is our opening stock plus purchase. And if you include in the purchase direct expenses, it is okay. Otherwise, you can add separately. So opening stock plus purchase. If I take separately, I would also add direct expenses minus closing stock. That is the equation which we are having, or that is a formula which we are having for the cost of the goods which we showed. Now to get the profit, what to do? To get the profit, we have to minus from the sale or the net sale this cost of the goods sold. So now if we a little calculate the formula here, the space here, balance it, the formula would be profit, and this is the gross profit. Profit equal to sales minus cost of goods sold, COGS, I'm telling in short, and that is, if I again expand this COGS, that is sales minus COGS expanded as opening stock plus purchase plus direct expenses minus closing stock. And now if we take out the bracket, if we remove the bracket from this cost of goods sold, so now this will be expanded and the sign inside the bracket will be changing. So when you take out the bracket, the minus enters, the plus sign will be minus and the minus will be plus inside the bracket. So here there is only closing stock inside the bracket which is minus, so after taking out the bracket will be plus. So the now the final equation for profit, which is a gross profit, is sales minus a plus closing stock, because closing stock becomes positive if you take out the bracket, minus opening stock minus purchase minus direct expenses. So this is the ultimate formula which we have used in the format, that is net purchase added with the closing stock minus opening stock minus net purchase minus direct expenses. This carriage and wages are direct expenses pertaining to the purchase. So we get the gross profit. As I told you, gross profit is not the ultimate profit, because this is only from the sale of the product. Like you bought the product and you sold the product, what margin you got by buying and selling, that is the profit. That is, we call it as gross profit. It is not absolute the ultimate profit of the business. Beyond buying and selling, there are so many other business expenses which we incur. Let's say we have marketing staff, we are also having accounting and finance staff. There are a rent of the buildings which we are using for the business. So there are so many expenses which we incur apart from just buying cost and making the bought goods sold out. So then there are so many other expenses, business expenses. We minus from the gross profit. Gross profit is the just buy and sell profit. So these expenses here, for example, I mentioned employee cost or salary, wages, finance cost. Like, if you borrowed money from lenders or from banks, so you have to pay interest. That is called as a finance cost. Financing our business. So we pay interest as a cost of financing our business. That is called as finance cost, interest. Depreciation is the conjunction of fixed asset utility. The assets which we use in business, let's say we are using a truck to carry goods from our store to the customers doorstep, or it just take the goods from the business and distribute to various customers throughout the day. So when you are using the truck's utility or trucks, I believe the useful life of the truck also reduces with its use. So the consumption of utility of the asset or the truck here, we charge it as depreciation. That is an expense. How much value the truck or how much utility the truck loses every year, every period, that is what we call it as depreciation, consumption of fixed asset. Then any other expense we can minus. Also, business is subject to income taxes, so we minus income tax if at all business has to pay it. So from the gross profit, which is simply our buy and sell profit, if you are into also manufacturing business, yes, this gross profit would be the profit from your manufacturing activity, which you buy raw material, you process it, incur processing or conversion cost, you get the finished goods, you sell it. So that profit, which we call it as gross profit, either buy and sell or buy, process, sell. That profit is gross profit. After that, there are so many operating expenses which we minus. And then all expenses when minus out, we get the ultimate profit, or this is the profit for the owner, which the owner can take home. The owner can use for his personal survival, because the owner's job is to run the business. So at the end of the day, the owner would be getting a remuneration or kind of a reciprocal benefit of giving his time to the business or managing business or taking the risk of doing business. So that is the owner's reward, this net profit is. So it is the take home profit for the owner. And once we calculate the profit, immediately we never hand over the cash to the owner for the profit. Generally, this net profit is getting added to the owner's capital in the business, because owner has already given fund to the business to start it. So he has or she has some sort of money which is lent to the business, which we call it as generally the capital. So what we do, this net profit when calculated would be immediately added to capital. Later on, that is the owner's fund in business. Capital is the owner's fund in business, and later on the owner can withdraw or take money from his capital. So basically capital is shown in the balance sheet. And here, if I show you down, you see here, the capital is there. Okay, basically in the company form of business, we use share capital, and in smaller businesses, this will be only capital. This part would not be there, let's say, share part would not be there. So now only capital in smaller businesses, we say it. So here the capital and the net profit will be added to it. And later on, if the owner wishes to take some money for his personal use, he or she will be taking out of the total capital. Okay, so he can withdraw his profit or some portion of his profit. So this is how we have to prepare the income statement. So we take the revenue, that is the sale, which is always net sale, and we adjust for the cost of goods sold, which is opening stock plus purchase plus other direct expenses which we incurred for purchase, and minus closing stock. And at the translation or expansion of the entire equation, we get The gross profit calculation is net sale, our closing stock minus opening stock minus net purchase minus that expenses, we get the gross profit. And from gross profit, all other business expenses we minus, we get the net profit. This is the income statement for a not for for a smaller business, not for a corporate entity. But here I mentioned here the limited. So the limited what is used basically for company. Okay, I just mentioned here, which is you can say ABC Enterprise. Enterprise. Okay, so this is a non-company business. Now we will go into the format of the balance sheet, which is basically the detail of resources and obligation of the business. Resources and obligation. So resources, which we call it as assets, obligation, which we call as our liability, and equity. Equity basically nothing but capital. Capital fund of the owner. How much owner's investment in the business as on the debt, or as of now, how much money is owner's money in the business, and how much money is the outsider's money in the business. And these owner's money and outsider's money, this is liabilities, outsider's money, lender's money. And this equity or capital is owner's money. So the two sources of fund, they supply the necessary fund to create the asset and run business. Like the asset which we created, let's say land, building, some example, plant, machinery, furniture, and all these are the assets which we created with the fund supplied by owner and the outsider. We create asset, we run business. Generally, when we look business, we see these assets. We see generally business as these assets. But this equity or capital liability, we generally do not see it. They are taken, they are on the pen and paper only, they are on the record. So we generally do not see equity and liability, we see a business as assets. Since these funds are taken and used for creating these assets, so we see the assets only. And these funds, who given the funds and all these are on record, we find. So equity liability you generally do not see somewhere, they are on record. So now the beautiful relation which we understood, that is the accounting equation, asset equal to liability plus capital, that is established here. So every time your asset which you create is equal with liability, that is the outsider's fund, and capital or equity is the insider fund or owner proprietor's fund. So in the balance sheet we see that it is manifested here. So balance sheet is nothing but a 3-component accounting equation. This is a 3-component accounting equation. So once we put our assets, so we will sum total all assets here, let's say we will get the total assets, and we will also sum total our liability and capital, liability, equity, we also get the total liability and capital. But the thing is, it is called as a balance sheet. It is a self-balanced statement. It is never balanced manually. It will be balancing itself. So therefore it is a balanced statement or balanced sheet. So it will be automatically matching. So always, let's say this is A and this is B. So always it will be A equal to B. So therefore it is a self-balanced statement. Balanced sheet or statement. So it is called as balance sheet because it is self-balanced. A equal to B, automatically it comes. So with this fundamental understanding of financial statement of a small non-corporate, non-company business, generally as a part of their financial statement, they prepare, here we understood financial performance statement and financial position statement. Financial performance, we call it as statement of profit loss or income statement. And when you prepare in T format, a ledger format, you call it as profit and loss account, which shows net profit, basically the net revenue, and other statement there is balance sheet, which show basically resources and funds of the business, and it is built on the fundamental concept of accounting equation: asset equal to liability plus capital. That's the theory and very, very important part of financial statement understanding. Let us do a financial statement from a set of transactions, and we will get the accounting equation next, and then on the basis of accounting equation we will get the trial balance, and these trial balance figures we will be using in preparing the financial statement later. So here we have a set of transactions. Let's say the proprietor starting business with 50,000 cash, then paying into bank or opening bank account, purchase made on cash and credit, selling goods, rent paid, outstanding rate is 100 even, then bought furniture, which is an asset. So all these are transactions which we have. Now we will draw the accounting equation based on the transactions which we have. So these are the accounting equation entries. So this is basically a 5-component accounting equation, because 5-component accounting equation is complete one. You have asset, liability, capital, as well as income and expenses, which you can use to prepare both income statement and balance sheet. 5-component accounting equation. So this side in the 5-component accounting equation, we have asset and expenses, and other side we have liability plus capital and income. So here we have cash as an asset, bank as an asset, stock asset, cost of goods sold is an expense, rent is an expense. This is cash asset, bank asset, stock asset. Cost of goods sold, this is the cost price of the goods which you have sold. That is an expense because this is made to generate revenue, that is the sale. So this is an expense, cost of goods sold, COGS. And rent is also expense. Furniture is an asset. Motorcycle is an asset. So these are all asset and expenses. Other side we have equity, which I told that this capital, or the name of equity is capital fund or capital. So capital fund is there. Then this is capital. Trade payable is a liability. How much we have to pay to our suppliers, that is trade payable. So this is a liability. Sale is income, and rent payable is liability. How much rent which we have to pay to the landlord. Some rent we have paid, still something is due to him or her. So that is also obligation or liability. So these are the I believe account heads, which maybe asset, liability, income, expense, or capital. We got it. Then we will do the entry of all the transactions. So we have done the entry of all the transactions, the 9 transactions. So we have entered them, and we got the net balance of every account appearing in the accounting equation after all the transactions are entered. And also when you enter the transactions, the account equation, after that you get the net figure. And if you total the net figure, both the side, left hand side, right hand side, here we are getting also the equal figure. Total both the sides is equal. 1,20,100, 1,20,100. Because that is based on accounting equation where our asset plus expenses equal to liability plus capital plus income. So this is the accounting equation. Obviously, the sum total will be matching both the sides. So here, these are the balances we got. And if you present little, statement format, next, the statement which we call it as trial balance is looking like this. Just arrangement of accounting equation, net figures, the accounts they are involved in the account equation, the net figures we are just presenting in a statement format. We have cash here, we have bank here, stock, rent, furniture, motor car, then capital or equity. Then we have trade payable, we have sales, rent payable. So all these we are presenting here. Just this is called as our trial balance, and this trial balance we use to just pick the figures to prepare our financial statement, that is our income statement or balance sheet. So we got the trial balance, which is nothing but presenting the accounting equation net figures in a statement format. This net figures of the accounting equation in the normal accounting process we get from ledger. These figures which you are having here, we generally get them from the ledger account. If you prepare ledger account, these net figures you get from there. So now once we have the trial balance, let us get into the income statement. As we know the format of the income statement, accordingly, just we have to put the figures at appropriate places. Net sale, here there is no return. So we will take this just sell figure. The sell figure is here 40,000. 40,000 we'll be taking here. There is no other income at all. If any other income, let's say some money we have deposited in bank or something, like interest we are receiving from bank. So that is not our sell income. This is basically our side income. So if at all we have any side income, we will take it as other income. We add to our core income, that is sell. And the cost of the goods sold here, this is COGS, the cost of the goods which you have sold out. This is 30,000. That is no direct expenses, only let's say without incurring direct expenses, because we handle as an owner, we handle it. So only we have cost of the goods sold 30,000. There is no direct expenses like carriage on purchase or wages. So this is a small example to understand. So we take it at zero. But in big businesses, generally we incur so much of direct expenses. These are all to be added to purchase or be part of the cost of the goods sold. So now if you net it off, net sale and the cost of the goods sold, these two, 30,000 and 40,000, we are getting as this gross profit is for 10,000. So this is the gross profit. This is the crude profit, not absolutely the filtered one, because there are still certain expenses to be adjusted or to be netted off. So now we have gross profit. See what other expenses which we are having. So here the list of expenses which we have taken. Certain, just I mentioned the format which we have discussed before. Certain expenses may not be present, and this is a small example, and we see only one expense is there. That is the rent. Rent is the one expense. Rent. So this is the only one expense. In a normal practical business, you see there are so many expenses: rent, salary, your interest, your advertisement, printing, stationery, discount. So much expenses you find. So whatever expense you find, you put here after gross profit, because those cost of the goods and related expenses we basically minus from the sale to get the gross profit. After that, all other business expenses, including our income taxes and all, we minus from the gross profit, and we get the net profit. Here there is only one expense for our understanding, small example, and we get net profit as this, which is absolutely ultimate profit. Ultimate profit is the proprietor takes home, and it is the reward to the proprietor for taking business risk. 9,400. As I told you, this net profit is to be given to the proprietor through its capital, because the proprietor is having the fund in business. So we do not hand over immediately after calculating to the proprietor the net profit. Rather, we add it to the proprietor's capital. That we have to remember. So here you see, this is the net profit added to the capital. Had it been loss business we are doing, we are taking risk, obviously, there are chances that we may suffer losses. So when there is loss, we will be minusing from the proprietor. So that is the risk of the proprietor. That is a business risk. So here the proprietor's capital is called as equity. You can say capital as well. More, a really contemporary accounting jargon way, we call capital as equity. So the capital fund is 45,000. Now we added net profit 9,004. This is the total capital fund becomes after adding net profit. Then other liabilities, let's say here, let's say if we finish first, since we discussed first capital, and then let us finish the liability part, then we'll see asset. So other liabilities are, let's say, trade payable. I'm just speaking from the trial balance, because in the trial balance, couple of things are taken care of. If you see the trial balance while preparing income statement, we have taken care of cost of goods sold, rent, and sales. These are the three things taken care of. Rest things are either assets or liability or capital. So, basically in the liability, capital, and income, here we have, they are the other side. We have, this is basically trial balance. This is asset plus expenses, and this is liability, capital, and income. So income is taken in the income statement or profit loss statement, and here we also taken equity or capital. This part also taken care of, and the rest here are only liability, because income is taken income statement. Now we have taken also capital, rest would be our liabilities. So sale also taken 40,000. So we have, sorry. So we have sale. If I highlight, sale is also taken care of. So only two things are remaining. These are our liabilities. One is our direct payable, other one is the rent payable. So these two liability we will show to complete our liability side. So 35,000 and 100. And then rest of the things in the entire trial balance are the assets, because they are in the other side. With expense and assets we have here, the first column. And already expenses are taken, because this side consists of asset and expenses. And expenses are already taken. That is cost of goods sold and rent. The rest of the things are, or rest of the items in the first column, asset and expense column, would be only our assets. So cash, bank, stock, furniture, then motor car. So these are all to be taken in the balance sheet. This. So this is our all balance sheet things are taken, assets are taken. So we see our balance sheet total is coming around this 89,500, and also the liability and equity side total also 89,500. So this is how we prepare the financial statement of a non-company business. They are smaller businesses, and as I mentioned, they do not have any prescribed format as per any law applicable to them, because there is no such highly, I believe, applicable law, or there is no such highly what I call it as recognized law or guidelines or regulations governing this form of organization. So they are generally following the normal standard accounting guidelines. So they use the standard accounting practices to prepare the financial statement, the income statement, and the balance sheet. The way we prepare, we understood here with the example. So you can also go for a little more item based financial statement. Here it is a financial statement where there are more items in the trial balance. We can prepare also with the same manner exactly. First we prepare the income statement. We get the net profit here, and then we take the net profit to the capital, add it to the capital, and then other liability and all we put in the liability side, and equity side, and assets we put in the asset side. Then we sum it off. We get total of asset will be equal to the total of liability. That is the very fundamental relation, and that is also something to be taken as a proof of correctness of our answer of the financial statement which we prepared. So asset equal to liability plus capital. That is the equation it is satisfying. So thank you so much for listening to this video, and learning many things on how to prepare financial statement for smaller businesses. Thank you.